With about a fortnight to go until Britain decides its future in the European Union, nerves are starting to show in the UK's gilt markets. With me to discuss this is Mike Riddell, fund manager at Allianz Global Investors, who notes gilts very well. Mike, thank you so much for joining us.
Thank you.
So if we can look at 10-year gilt yields and what they've been doing recently, we can see that the rates have been coming right down. So that means that people have been really buying gilts at the moment. Why is that?
Well, I think it's a common misperception that gilts are driven by UK factors. And I think particularly with 10-year gilts, what you find is that the correlation is very high with US Treasuries, for example. And we saw that just last week. We had a very weak non-farm payrolls number, and that resulted in a very big gilt rally, which we saw at the end of last week. I think where you'll see Brexit risks, and not so much in 10-year gilt yields, is probably much more in short-dated gilts, which are driven much more by what the Bank of England is going to do to interest rates over the next 1 or 2 years.
Okay, so if we look at the 2-year gilt yield chart in that case, and we can see that there's been a similar move down in the yields, which means there's been a rise in the prices. So how can we distinguish what the Brexit movements are compared to the other movements?
I think with 2-year gilt yields, what you're seeing is, as you say, a big drop in yields as markets have pushed out their expectations of interest rate hikes. And indeed, only in November of last year, the market was expecting a hike within about a 12-month period. Now we're seeing expectations are 50-50 between will the UK actually cut interest rates this year. As a result, 2-year gilt yields and shorter dated gilt yields generally have fallen substantially.
So if we make the connection there, the idea is that if the UK does vote to leave the European Union, that the UK might then cut interest rates?
That wasn't obvious, I'd say, until we heard Mark Carney speak at the inflation report in May, where the indication was that if the UK does vote to leave the EU, we'll see a material downward risk to growth and also a substantial increase in inflation. The Bank of England suggested they would actually look through the increase in inflation. They worried more about the material risk to growth, and they'd react to that potentially by cutting interest rates, and not just cutting interest rates. Mustn't forget there are other things the Bank of England can do in terms of QE, for example. That could be back on the agenda the second half of this year, as the Bank of England counters what will likely be a UK recession.
So if we look at what's been happening even in the last few weeks, this movement in the gilt yields has been really connected to some of the opinion polls that have been coming out that have narrowed, right? So we've seen that as it looks more in favour towards leave, we've seen people buying more into gilts, and that's been happening a lot more in the last week, hasn't it?
Yeah, I think the opinion polls have been very volatile, and I think most people think not very reliable, because you have to remember that they haven't had anything to model. This is a very new scenario for them. But I think the bookmakers are generally seeing as a better indicator of what might happen to post the referendum, or what the vote will be on the day of the referendum. Even the bookmakers, though, have got a lot of uncertainty to deal with, and we shouldn't forget that they gave odds of 5,000 to 1 for Leicester City to win the Premier League and got that one spectacularly wrong. I mean, at the moment, to give an idea of what the odds are, they're saying it's about a 2 to 1 chance that the UK votes to leave the EU. That's about the same odds as England getting to the semi-final of the European Championships. So, it's more likely we'll stay in the EU, but there's a material risk that we won't. And I'd argue that markets generally are not pricing this in correctly.
So if we look at the market that's really showing the volatility, that's sterling, right? So that's currencies where we're seeing huge movement at the moment. Yeah. And why is that more so than gilts? It's
currency, I think, largely because the UK has got a very big current account deficit. It's actually one of the biggest in the developed world, of around 7% of GDP. So there is a risk that there'll be some kind of sudden stop or funding crisis. I think these fears are a bit overblown, but clearly some people put weight on this. If the UK leaves the EU, foreigners will sell their holdings of UK equities, if the UK is in recession, or might even be selling down gilt holdings. And these fears are reflected in the currency market.
Mike Riddell, thank you so much. So with opinion polls narrowing and so much uncertainty about what might happen in the aftermath of the referendum, it looks like set to be another volatile couple of weeks in the gilt market.
The market is finding the Brexit possibility increasingly hard to ignore and difficult to play. So how should investors trade Brexit? Brexit would almost certainly cause a